Welcome to Issues in Conservative Growth Investing, the first in a new series of discussions sponsored by Enriched Investing Incorporated. I'm Darryl Cailes. Join me here for informative discussions ranging from the macro outlook, updates on our current strategy, and special guests from a range of areas of public life, business, and the economy. Conservative growth investing has a unique set of challenges and opportunities. We aim to fill the knowledge gap and empower individuals and institutions to make more informed investment decisions in the capital markets with financial education and industry insights. Our objective is to help investors make smarter decisions with their money. With the help of our first guest, in-house economist David Chapman, we keep an eye on the macro factors that affect the preservation of your capital. David is the author of the widely read newsletter, The Technical Scoop. David has been analyzing markets to inform investors for over 40 years. His understanding of market drivers clarifies investment risks, clearing out the noise to help identify market opportunities. David, welcome to the show. You and I and our CEO, Margaret Samuel, go back many years in the investment business. We've seen many crises in the financial sector over the years and have happily come through with capital intact. David, what was your rationale for joining Enriched back in 2017?
One of the prime reasons was Margaret Samuel, whom had worked with me at one point in time, many years earlier, when I was in another role and industry at the time. And in fact, I had been writing the Technical Scoop for quite a number of years in various forms. And I saw this as an opportunity to continue writing and have it distributed by a firm on Bay Street, which would widen the audience that I brought.
You're known as a technical analyst. How does your approach to the markets differ from fundamental or quantitative analysis?
Well, first of all, a technical analyst, a real technical analyst can sit there and look at a chart and determine what that chart might happen to do. Without having to even look at the fundamentals or quantitative or anything. I started looking at charts and technical analysis nigh on 40 plus years ago when I thought it was an interesting addition to the market as a whole and gave me another venue in looking at the markets. So it's chartist based and it has its own special language and everything that is very different from any macroeconomics or microeconomics or quantitative guys. Very different.
Would you say that as a technical analyst, it would be redundant and there'd be no point in looking at the fundamentals?
You can do it, but I've never really done it. I've known people who kind of poo-poo a bit over technical analysis and said, well, it doesn't work. But as a predictive form, it can actually be a very useful tool in spotting potential trend changes before they actually happen. And I think that's one of the key things that you might not notice doing straight fundamental analysis. The regular investment world has a tendency to try to look at the markets and everything with kind of rose-colored glasses, so to speak, because they're basically selling their products and their investment management skills to their audience and not looking at what goes on. I grew up in money markets where we had to look at what might happen down the road that might affect our portfolios. We're not trying to satisfy customers per se.
Right.
Our focus was on the portfolio and managing the portfolio. So technical analysis was just a tool that we looked at to try to look at trend changes in the market.
So from your viewpoint, technical analysis improves an investor's return.
It can help anticipate, particularly trend changes and in different sectors of the market that might be changing because not all sectors move simultaneously. Sometimes they do, but more often than not, they don't. There are
Right.
certain sectors that outperform at certain points in time, and you want to be on side with the ones that are moving.
So you can see this in charts before it becomes apparent.
You can see
Otherwise.
potential trend chases, but sometimes these trend chases take a while. They don't happen
Right.
overnight. Yeah.
So does what you do, can that be of value to very conservative investors that we have at Enriched, as well as those who prefer a more aggressive portfolio of growth and income?
Well, I think the technical analysis that I do, because I combine it with macroeconomic analysis to try to identify trend changes over a period of time. And if you can catch these trend changes and be on the side of them, you can hopefully avoid the pitfalls of markets that go sharply against you, and be on board with the markets when they tend to change.
So you would hopefully find a trend change to the upside for the investor who buys equities. And the trick, I'm assuming, would be to then, for the one who likes to trade a little bit, when the trend has gone on for a while, and how do you anticipate when the trend is going to change to the downside? Do your charts give you much
Yes,
help with that?
Absolutely. An example I love to use is the 2008 financial crisis. At the time, I was an investment advisor analyst working for a smallish Bay Street investment firm. And one of the things we noted was the macro problems, because they had creeped up with the collapse of the Bear Stearns funds. Plus, there was a lot of other trouble, and the subprime loans were starting to become an issue, but the markets hadn't cracked. But we could see from the charts that we were starting to make what we technical analysts call lower highs, meaning the market would go down, it would try to come back and make a lower high. And then it would go down again, make another lower high. And it was very slow at first, because that's the way they usually start. And then it was at that point in time you go, hold on, there's a big problem here, because we see the macro problem creeping in here with the subprime loan market, and I see a technical pattern that indicates that the market could suddenly shift from a slow decline to a very fast decline once everybody realized what was going on. And I can remember at the time insisting with a lot of my clients that I had at the time, we got to raise cash and get out of the market. And sure enough, in September of 2008, was the infamous collapse of Lehman Brothers, and it shocked a lot of people and caught a lot of people in the market completely offside. But the events over the next 2 months also gave us indication that we were also going to make a bottom in the market, because it became such a panic that you had to start looking at it from the opposite side.
Things got oversold.
Not only did it get oversold, there was such panic in the market. And while he's a famous fundamental analyst in Warren Buffett, he had a neat little saying of sell when they're greedy and buy when they're fearful.
Yes.
And in the late 2008, early 2009, the market was very fearful.
Right.
So we figured at that point in time,
I remember, yeah.
time to shift.
Yeah.
And bank stocks in particular had been extremely beat up, and we loaded up on bank stocks because we just thought we're oversold, the market's too fearful, we're probably poised for a rebound. And sure enough, helped by governments and central banks pumping huge amounts of money into the market, lowering interest rates to zero, they set up the conditions for the coming rally afterwards.
Would you say that was your best year?
Well, it was probably a very it's a good, successful call, but even I could admit I've had a few that I missed too as well.
Sure. There have been some smart people who have designed investment strategies almost guaranteed not to lose money, but they failed in spectacular ways. How does technical analysis help you avoid the pitfalls of a crash like 1987?
Well, what happens normally prior to a crash is that there is kind of a setup in terms of how the market acts. And 1987 is a classic example. There was a nice little rise to a top in August of 87, and then the market broke down. And then it comes back. But in some cases, it comes back, but it doesn't make those old highs. Sometimes it actually makes new highs, but it doesn't go much beyond that high. In other words, a false breakout. It's going to bring a lot of people in. Then it turns down again, and then once it hits certain support points, you're looking at them and going, wow, if those support points break, we could fall fast. And that is exactly what happened in 1987. It came back, the market went down, came back up, went down again, tried to go back up again, making a bit of a platform. Mm-hmm. And I've seen this same platform prior to other crashes. And then once the platform breaks, it accelerates and goes fast.
Right.
And we'll be talking about some of that in this upcoming scoop.
Right. Our Enriched Capital conservative growth strategy focuses on companies with robust cash flows and solid balance sheets. How does your approach to markets contribute to the successful long-term performance of our Enriched Capital conservative growth strategy?
I have to project how I think it might help in terms of giving the company advanced insight into the potential for markets to change direction, markets to break and even have a crash, and or just shift from a bull market to a bear market. A lot of times it's very subtle how it changes, but it's trying to pick up the signs that suggest that even for conservative accounts, like, maybe it's time to batten down the hatches a little bit, or to move into more defensive position and to wait it out and see what happens. And oftentimes that strategy protects you from a potential disaster.
So the technicals give you a warning that something is afoot before it actually happens. You
Absolutely.
can see something doesn't fit right.
Something doesn't look right, doesn't fit right.
Building, bubbling away.
Yeah, precisely.
So then it's time to consider
a defensive
strategy. We always focus on, in return to our core mandate, buying tried and true businesses with a history of growing dividends. Are you able at all to identify these types of businesses with technical analysis by their stock price?
Well, I could, but the type of analysis I do focuses more on the overall big picture, right. As opposed to individual companies themselves.
Yeah.
And I certainly look at sectors of say, the TSX or even the S&P, and to see what those charts are trying to tell me, and it gives me clues as to which sectors maybe it would look like I should avoid, and versus other sectors which make it look like maybe I should accumulate these sectors instead.
You know the stocks to look at in those sectors, depending on what the overall sector analysis.
Yes, absolutely. As opposed to I don't know what the individual stocks are doing in them, but I just look at it from a sector standpoint.
Exactly.
Probably an excellent example is the high-tech sector. First of all, there was signs that the high-tech sector, particularly on the AI stocks, were going into some sort of a bubble. And you realize that the S&P 500 is primarily going up on the backs of about 7 to 9 companies. Because you look over at the more equal-weighted S&P, where those same companies are no longer weighted, but they're just on the same level as the weakest stock that's in the index. Yeah. And the S&P equal weight index is trading way below or actually diverging from the big cap stuff. Whereas one has been going higher and the other one is not going higher.
Right.
So you have there's a problem here.
You can see something.
Yes, and maybe it's time to take some profits on those high tech stocks that have been rising. And that did prove to be the case here recently, and to a different extent a year ago when the markets topped in January of 22.
A valuable insight to have. Well, thank you for being with us, David, on this, our first episode of Issues in Conservative Growth Investing. Thanks to you out there also for joining us. Look for upcoming discussions soon.